Welcome to part 2 of this week's live chat discussion. We continue with a brief look at several more key definitions and investment concepts as we explore the world of investments, followed by a closer look at investment companies, also known as mutual funds. In our continued exploration of financial markets, distinguishing between primary and secondary markets is crucial for understanding the life cycle of securities. The primary market is where securities are created and sold for the first time. The pivotal aspect of the primary market is that the issuer of the security is directly involved in the transaction and receives the proceeds from the sale. This market is vital for raising new capital. There are two types of primary market offerings. Public offerings. Securities are registered with the Securities and Exchange Commission, or SEC, and offered to the general investing public. This process typically involves a prospectus that provides detailed information about the offering. Private offerings. These are not registered with the SEC and are sold to a limited number of qualified investors. Private offerings come with restrictions on resale, often to maintain the private nature of the investment and to comply with regulatory requirements. Moving on to the secondary market, this is where existing securities are traded between investors. The key distinction here is that the issuing firm is no longer involved in the transaction and does not receive any proceeds from the sales. The secondary market is what most people are referring to when they talk about the quote-unquote stock market. It provides liquidity and price discovery for the securities being traded. Understanding the functions of primary and secondary markets is critical for investors. The primary market allows investors to purchase securities directly from the issuer and participate in the initial pricing of a security. In contrast, the secondary market provides them with a platform for trading these securities after the initial sale, thereby offering them the flexibility to adjust their investment portfolios as needed. In the context of investment trading, it is critical for market participants to understand the various costs associated with trading securities. These costs can affect the overall return on one's investment. Firstly, we have the commission, which is a fee paid to a broker for executing a trade. This fee compensates the broker for the service of connecting buyers and sellers and facilitating the transaction. The second component is known as the spread, which represents the cost of trading with a dealer. The spread is the difference between two crucial prices. The bid price is the highest price a buyer is willing to pay for a security. The ask or offer price is the lowest price a seller is willing to accept for selling a security. The spread, therefore, is the gap between what buyers are willing to pay and what sellers are willing to accept. It can be viewed as a measure of the liquidity of the market. A smaller spread indicates a more liquid market, and vice versa. Dealers earn their profit through this spread. Lastly, a combination of these costs can occur in a single trade where both the commission and the spread are paid by the investor. It's important for investors to understand these costs because they can impact the net return of their investments. Understanding the bid-ask spread is particularly important because it represents the transaction cost inherent in trading securities, not including commissions or other fees. When you buy a security, you pay the ask price, and when you sell, you receive the bid price. The wider the spread, the higher the transaction cost for the investor. Image used with permission from Wall Street Mojo. wallstreetmojo.com. Next, we investigate the concept of buying on margin, which is a crucial technique in the world of finance and investing. Buying on margin is defined as the process of borrowing funds from a broker or dealer in order to purchase stock. This practice enables investors to leverage their investment by using borrowed money to increase their potential return on investment. It's important to note that while buying on margin can amplify gains, it also increases the potential for losses if the investment value declines. The initial margin requirement, or IMR, is a critical regulatory component when buying on margin. This requirement is set by the Federal Reserve under Regulation T and stands at 50% for stocks, meaning that an investor must provide at least 50% of the stock's purchase price with their own money, while the remainder can be borrowed. The initial margin requirement represents the minimum percentage of the total investment that the investor must hold as their initial equity. If the value of the stock declines significantly, the investor may face a margin call, which means they will need to deposit additional funds to maintain their equity at the required minimum percentage. It is essential for investors to understand the risks and responsibilities that come with buying on margin. To further elaborate on this concept, the highlighted article by James Chen on Investopedia entitled Buying on Margin, How It's Done, Risk and Rewards, published on April 21, 2021, provides an in-depth analysis. The article discusses the mechanics of margin trading, the associated risks, and the potential rewards in a detailed manner. Investors considering this strategy must be well informed about the mechanics, must monitor their investments closely, and must have a risk management strategy in place to address any market volatility that could affect their margined positions. What exactly is a margin call? A margin call occurs when the value of an investor's margin account falls below the broker's required amount. To frame it within the broader context of margin trading, let's define key terms and outline the process leading to a margin call. The margin call is a broker's demand for an investor to deposit additional money or securities into the account to bring the equity in the account up to the minimum required maintenance margin. This typically happens when the value of the securities purchased on margin decrease significantly. What triggers a margin call? An investor receives a margin call when the market value of the securities held in the margin account declines to a point where it no longer satisfies the initial margin requirement, or IMR. Calculating equity in margin trading. Equity in a margin account is the difference between the market value of the securities held in the account and the amount borrowed from the broker. The formula is quite simple. Equity equals market value of securities minus the amount borrowed. When an investor buys on margin, they are essentially using borrowed money to increase their buying power. The Federal Reserve's Regulation T currently requires that the initial margin, which is the percentage of the purchase price of the securities that the investor must pay for with their own funds, be at least 50%. However, as the price of the securities fluctuates, so does the equity in the margin account. If the securities value falls sharply, the equity can drop below the required maintenance margin, which is often lower than the initial margin requirement of 50%, but still a set percentage of the total market value of the securities. Declining market value and margin calls. If the stock price declines, the market value of the securities decreases, which in turn reduces the investor's equity. If this equity falls below the maintenance margin, the broker can issue a margin call requiring the investor to deposit additional money or securities to meet the minimum equity requirement. Responding to a margin call. If the investor does not meet the margin call, the broker has the right to sell securities from the account to increase the account's equity until it meets the maintenance margin. This is typically done without prior consent from the investor due to the signed margin agreement when the account was opened. Understanding margin calls is essential for margin trading. It involves recognizing risks associated with borrowing to invest and the potential for rapid losses if the market becomes unfavorable. Next, we examine investment companies with a spotlight on mutual funds to understand their structure, operation, and benefits offered to investors. What exactly is an investment company? It is a formal organization, either a corporation or a trust, that pools together investors' capital to invest in a broad range of financial securities. By aggregating the funds of many individuals, investment companies can achieve economies of scale and offer diversified investment opportunities. The role of mutual funds. As a subset of investment companies, mutual funds are particularly designed to allow individual investors to partake in a professionally managed and well-diversified portfolio. They enable participation in markets that may otherwise be inaccessible to individual investors due to high minimum investment requirements or complex trading strategies. Key features of mutual funds include diversification. One of the primary advantages of mutual funds is diversification. By investing in a wide array of securities, they reduce the impact of any single security's poor performance on the overall portfolio. Professional management. Expert fund managers oversee the fund's investments, making decisions about buying and selling securities based on thorough research and analysis. This offers investors the benefit of expert management without the need to directly manage their own investments. Liquidity. Mutual fund shares are liquid, typically allowing investors to buy and sell their shares at the fund's current net asset value, or NAV, at the close of each trading day. Affordability. The structure of mutual funds enables individuals to invest in a diversified portfolio with less capital than would be required to individually purchase a similar range of securities. In essence, mutual funds provide an accessible way for individual investors to gain exposure to a broad spectrum of investments managed by professionals with the flexibility to adjust their investment positions daily. In this examination of managed investment companies, it is vital to distinguish between the two main organizational structures they may adopt: open-end and closed-end funds. Open-end funds. Open-end mutual funds are characterized by the ability to issue and redeem shares at any time. An investor purchases shares directly from the fund and sells them back to the fund whenever they wish to withdraw their investment. The key feature of open-end funds is that the fund will create new shares when investors want to buy and will buy back shares whenever investors want to sell. The share price is determined by the net asset value, or NAV, which is calculated at the end of each trading day based on the total value of the fund's underlying assets. Open-end funds are popular for their liquidity, as investors have the flexibility to enter and exit their investment on a daily basis. Closed-end funds. In contrast, closed-end funds operate more like traditional stocks. Once the initial public offering, or IPO, is complete, the fund does not create new shares or redeem existing ones. Instead, shares of closed-end funds are traded among investors on a secondary market, such as the NASDAQ or other stock exchange. The market price of the shares can differ from the net asset value because it is determined by supply and demand dynamics in the market. Closed-end funds often trade at a premium or a discount to the net asset value, offering unique opportunities and risks for investors. Implications. The choice between open-end and closed-end funds should be informed by an investor's liquidity needs, investment strategy, and willingness to potentially buy at a premium or sell at a discount relative to net asset value. Understanding the mechanics of both fund types is crucial for investors, as it impacts how they can manage their investments and the kind of market dynamics they may face. This concludes our live chat discussion for now. If you are attending the event live, feel free to stick around for a brief question and answer session. If not, post your questions on the weekly Ask Questions discussion board or contact me directly via email, voice, or text. See you online.